Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. I really enjoy doing these almost daily Zooms, as I call them, and some of them make it to our YouTube and our podcasting platform. To give a little context to my discussions with our wonderful guests that we have on, I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. It's vital for families and their family offices to understand their vulnerabilities and become more resilient so they can mitigate risk and prevail during times of crisis. My experience with some of the wealthiest families in the world has allowed me to distill best practices for discovering purpose and refining vision, governance structures, systems, processes, and culture that successful families and their safeguard family offices need in order to thrive. Our session today is titled Undervalued: Tax Benefits, Investing in Angel and VC. Our special guest is Joe Milam, founder and CEO at AngelSpan. I really look forward to talking to Joe. He has an amazing background, mainly in Silicon Valley for many, many decades as a managing principal of a multifamily office, so used to understanding the community of angel and VC, of ultra high net worth. He now resides in kind of the burgeoning Silicon Valley in Texas, and that would be Austin. As I noted, he's the founder and CEO of AngelSpan, and he's built a platform of tools and strategies to bring public market risk and portfolio management practices to the early stage private investing markets. He'll discuss some of the overlooked tax incentives which hedge the downside of angel and venture investing, while also providing for potential tax-free profits on successful exits. Joe, welcome to the show.
Thank you for having me. This is a real pleasure.
Oh, it's my pleasure. I got connected to Joe by a mutual acquaintance earlier during COVID, spring of this year, and we're October of 2020 now. And we connected here or there in some other sessions and discussions. And many of you know, I'm certainly a big believer in entrepreneurship, in America being a great country for people to start companies. And it's something we've been dominant in angel and VC. And hopefully, it may be a little debatable. We'll save that for a different time, but hopefully going to continue. Now, we all understand if we're earlier stage investors, no matter how good we are, a lot of the companies won't make it. And that is sad. But if we're able to get tax enhancements that many of you are probably not familiar with, and here's the scary part, and I don't know why, probably your tax professional who may be very competent somehow overlooks these. Now, if your company you're investing in does well and you potentially have a capital gain, there could be potential tax enhancements to that as well. So why don't we kind of jump right into it? And I know this is going to sound a little bit like a tax-centric dialogue, and to some degree it is, but to make it engaging, Joe, with his wonderful cigar, for those of you that are either live or going to watch this on video, he does as good of a job of this subject of really anyone. So Joe, what are these overlooked tax gems?
Well, thank you, Angelo. And they are overlooked. And for those folks that might be listening in or will hear the replay, if you're unfamiliar with them, you're in very good company. I've done presentations on these tax laws for now almost 20 years. Back in the aughts, if you will, I used to do presentations to CPAs in California. I was an expert, so they could get continuing education credits. And virtually none of them were familiar with them. As recent as 2015, I did a presentation to a $50 billion multifamily office, to their 18 staff CPAs on these tax laws, right there in Palo Alto, and they didn't know about them. On the same trip, I did a presentation to Wilson Sonsini's office in their South of Market office. And those junior partner securities transaction lawyers did not know about them. So not being aware of them, you're in very, very good company. There are two specific laws, and they're really companion laws, because the second one, which was passed originally in 1993, borrowed from the definition of the first one. And it falls under what's called qualified small business stock, or QSBS. And the first law was actually passed in 1958. And it was part of the law that launched the venture industry. And to stimulate investors in this new asset class, the government wanted to take the pain out of the losses because it is a risky process, allowing for losses to be written off against taxable income. It's that simple. This deductibility literally lowers your taxable income dollar for dollar. So it's not something that you recognize a loss if you invested in a startup and then you hold that and compare it to any gains you might have that year, and that would reduce your capital gains bill because your losses offset your gain. In this case, using this first law, it's called Section 1244 under the Qualified Small Business Stock, or Qsbs. It allows for losses on angel investing to be deductible against taxable ordinary income. Now, by definition, that means this applies only to taxable individual investors. Corporations can't utilize this, and endowments and pension plans and the like, they don't need it. So that was the first law. And much like we hear about the opportunity zones tax legislation, that's called fiscal policy or fiscal stimulus. These are where the government uses the tax code to stimulate new behavior, new investor behavior in particular. And this was passed in 1958 to stimulate more investments in startups. Now, it went along and it was utilized because principally the original venture investors back then were family offices. I believe the Rockefeller family office was the very first LP in the very first venture fund. And I'm sure they probably lobbied to have this tax law pushed through. But until the ERISA laws changed in 1979, which stimulated more LP investments from tax-exempt investors, pension plans and endowments to follow, largely most LPs and venture funds were taxable families, wealthy families. And so these laws were relevant. The professionals, the lawyers, the accountants, they were well versed in these laws because they were applicable to the large body of, or largely the body of LP investors through venture funds. And then the dabbling of angel investing that was taking place at the time. So the law's been around since 1958. It's called Qsbs Section 1244. And you can Google all this, of course. And it simply allows for your losses on your angel investments to be written off against your taxable income. Now, right there, it starts getting interesting. And we got to get in a little bit of the weeds because for those tax nerds like me and maybe Angelo on this, what makes that deductibility so interesting is it's actually a better write-off than if you as a wealthy person gave an equivalent amount of money to a nonprofit, a charity, 501c3. The 1244 deduction actually falls what's called above the line, above your adjusted gross income line when you're computing your taxes. And so it's one of the few above the line deductions, which actually is far more desirable. And, simply stated, investing in startups and losing your money is a better financial outcome than giving them your money to a nonprofit. It's that simple. So for those families that are really getting interested in this impact investing activity, this makes impact investing and maximizing 1244 applicability a no-brainer financially. It's a good financial outcome, a better financial outcome than giving money to charity. Now, the amount of investor dollars that qualifies under Section 1244, the law was passed originally. It allowed for the first $500,000 of outside money, got coverage under this deductibility. So anybody that was outside of that first $500,000, they figured the tax law figured that the business was less risky and you didn't need this stimulus. But those early dollars got the coverage. And then in 1978, they actually updated the law and realized that $1958, given inflation and what have you, they needed to index the levels and limits to inflation. So they doubled it and said, okay, the first $1 million of outside money gets coverage under this favorable tax law. And originally, when you invested and could utilize a 1244 write-off, you could originally only get $50,000 per year of write-offs. And that too was doubled in 1978. So as this law stands today, while we're still operating under 1978 dollar terms, the first $1 million gets coverage and you can write off up to $100,000 on a joint tax return, $50,000 for a single filer, 1244 losses. Any losses that might exceed that, then just simply get carried forward the way people are likely doing it today.
Okay, there's questions flying in, which is a great sign. To help set a little bit of the tone and get a little bit more clarity, I'm going to ask one or two questions, and I'm going to go back to back on the questions that came in. Do I need to be a direct investor, or could I be an LP in a fund and get this benefit?
By definition, the LP structure allows all tax treatments to pass through to the end investor. So it doesn't matter, is the quick answer.
And do I need to hold or have owned, whether directly or theoretically as an LP, the underlying company that I'm electing to write off for a certain period of time?
No. And there's a variety of ways you can realize that loss, by the way. If you're sitting in a company that is still alive, it hasn't technically gone out of business, but you own shares and there hasn't been it hasn't closed its shop, but it's barely alive. You want to manage your tax bill, you can actually sell your shares to somebody else for $1 a share or whatever, and recognize the loss that way. It doesn't have to be through bankruptcy either. You can actually sell your shares to somebody else and take the write-off. Now, I've actually helped, just to get a little sexy on that, I actually helped, I did it along with some other shareholders in a company. We were both angel investors. I sold my shares to another shareholder's IRA, Roth IRA. I took the loss, $12.44, and she got the shares at a penny a share in her Roth IRA. So if there's any gain, it's tax-free. If it recovers, it's tax-free. And I did the same with her shares. So she sold me her shares to my Roth IRA for $1 or a penny a share. I can't remember what the exact share, didn't matter. Because we sold equivalent amounts. It was an arm's length transaction, and we waited 31 days before they changed hands. So there's no wash sale rule. And we're both disinterested third parties. And we sold our shares to each other, took the losses ourselves, and put the shares in our respective Roth IRAs if there was ever a gain to be had that would become tax-free. So there's a variety of ways you can realize the loss to take the 1244 write-off.
I mean, as you're describing this 1244, I mean, I hate to say this, it's great. It almost sounds too good to be true. I am assuming going back to the late 50s when it was launched, and you mentioned perhaps good strategic work by the Rockefellers or others, this basically helped to spur what we now know as Silicon Valley, and why America probably has been dominant for a variety of reasons in entrepreneurship, startup, and VC investing. Although another irony, I don't think a lot of people are maximizing this. It would be even better for entrepreneurs and investors if it was more well-known and more people were actively doing it.
Well, that's right, Angelo. I mean, what you just said is really one of my passions. I've actually been lobbying to get 1244 modernized one more time. So just do, again, what they did in 1978, index the levels and limits to inflation. Because $1978 at $1 million, that's worth $3.8 million today. So what if the first $3.8 million got this coverage of this loss write-off? And then you'd be able to write off up to $380,000 per year against your taxable income of losses on your 1244 investing. That becomes a threshold that becomes very relevant to family offices. That's a meaningful dollar amount. And so I've actually been lobbying as hard as I can and trying to get somebody's attention in Washington to care about this. It takes you got to pay them to care. You know, it's pay to play, it's pay to care, as it turns out.
Very true. I mean, I guess you could argue now for the true definition of a single family office, whatever, hundreds of millions or more, this is relatively a small amount, but often they may only have 2 to 5% of their portfolio in earlier stage companies. So, you know, you start to do a couple of strategies, it adds up.
It adds up. Yeah.
You know, would you rather pay it to the government or put it to work, you know, because you're getting a benefit back and then putting it likely to work back into the system? And I think that would likely be the better choice. Now, when people go to look it up on Google and they put in Qsbs, more commonly, and we'll get to this shortly, the 1244 pulls up. Well, again, we're going to get to that. What happens if the company is successful and you have gains? Are there advantages you're not familiar with? But we all know that earlier stage investing, a lot of times they don't make it. And this could encourage us to be more active and aggressive investors for those that are qualified in earlier stage companies. But I would say even on search engines, probably unless you put in that plus 1244, it doesn't quite pop in your face. It's strange.
I know it. Well, it's a tragedy, quite frankly. And again, the industry that supports venture capital, the lawyers and accountants, they don't know about it. And technically, if you look at the venture capital world, or any partnership for that matter, whether it's a real estate or venture or private equity, doesn't matter. The governing laws of, if you're a general partner of a partnership, you have a fiduciary responsibility to report all relevant tax implications of your investing activity on behalf of your limited partners. Now, most VCs don't know about this. Most accountants, most attorneys, the support staff and industries around venture are unaware of this tax law. And again, principally because, best I can tell, when the ERISA laws changed and most of the investors became tax exempt, the knowledge base just fell off and the familiarity with it just fell off. And so you're not even seeing this getting captured on the K1s for those taxable LPs and venture funds that could utilize. They could be able to write off some of the losses in those venture funds, but if it's not captured on the K1 by the accounting firm, then those LPs don't get to utilize it because it has to be captured on the K1 by the accountants.
If I'm a U.S. citizen investing in whatever earlier stage companies offshore, would that qualify?
These are U.S.-based companies and U.S.-based investors.
Got it. And I know you already said so, but just to make it very clear to our audience, is this a tax deduction, a tax credit with limits? If you could just simplify that and be very direct.
Yeah, and again, any accountants on the call may want to correct me, but I believe the proper language is it is a write-off, a deduction. Like your itemized deductions, those are write-offs. And they're itemized below your adjusted gross income line. You list them, right? But the 1244 deduction is actually put on the tax return above the adjusted gross income line. So it actually lowers, you've got your taxable income, your reported W-2 or whatever your reported taxable income source is. And then you've got any above the line deductions, which there's only a few. And then you calculate what's called your adjusted gross income. And then you've got your itemized deductions, charitable contributions, medical expense, all these different things. And then oftentimes those are only deductible to the degree they're a percentage of your AGI. They exceed a percentage like medical expenses. And even with charitable contributions that are itemized, there's phase outs. The wealthier you are, the less you can actually utilize and deduct your taxable income with charitable contributions. So an above the line deduction is far more powerful. It lowers your tax bill quicker and immediate because it's dollar for dollar write-off against your taxable income.
If I'm talking something dated, which is very possible, our tax laws are beyond complex. Could it be limited by the alternative minimum tax, the AMT? Is that still around?
The AMT is still around. I do not believe 1244 is applicable. The 1202, which we'll get to, used to be an AMT preference item calculation, but it is no longer. But 1244, I do not believe it has anything, AMT has any applicability at all.
I'm going to run through some of the audience questions now. You partially answered some of them, but let's just do it. One question came in. Do the limited partners get the benefits you described through the K1 or other tangible documentation in case of IRS audit?
Well, that's the point. It has to be captured on the K1 for the LPs to take that deductibility. Okay, if the K1, the accountants that do the tax return on the venture fund say these are the 1244 write-offs, then you as a LP can take that and put it on your own tax return per the K1, and your documentation to support the write-off is the very K1 itself.
What happens if they don't put it on there?
You don't ever get to utilize it.
That's a problem.
Yes, it is. It's a real problem, frankly, in the venture industry.
Is there any benefit to the fund GPs of not putting it there?
Well, let me just tell you, I had a conversation with Bobby Franklin, the head of the National Venture Capital Association, about 5 years ago on this. And he literally said, I said, he wasn't familiar with 1244, by the way. He was certainly well familiar. In fact, they lobbied on getting 1244 up to the levels we'll discuss in a minute. So he was well familiar with 1202, but he wasn't familiar with 1244. I said, well, Bobby, even with 1202, why don't more VCs capture this information on the K1s? His answer was, I don't know, it pisses me off. They're just effing lazy.
I guess that answers it. Now, again, this would be no issue if it's a direct investment.
That's correct. You as an individual just need to do a little bit of record keeping. That's all.
Would you assume that significant LPs could call and complain to the fund, the GP, and push things along?
Well, the challenge with that is few of the LPs that know the law either. They don't know what they're missing. That's why we're talking today, Angelo.
I suppose so.
They should be demanding this.
Other questions that came in, I believe you answered it, but I'm going to ask it anyway. Joe, is there a maximum 1244 loss?
Again, $100,000 per year under the current law is the maximum you could write off per year.
Okay, so that is very limited, but again, and we'll get to some of the tax issues and the potential of what could be good, what could be bad a little later. Another question, what proof does one need to demonstrate a loss?
Great question. The proof, and I've got a gentleman that's my tax expert. If anybody wants to refile tax returns, he is a tax expert on these, one of the few CPAs that really is an expert on both 1244 and 1202. He's with Anderson Tax. He was part of the old Arthur Anderson tax practice and office in San Francisco during the 90s. His name is Jason Graham, and he's with Anderson Tax out of Houston. And so he has been my backstop as he's heard me present. He signs off on everything I'm telling you because he's already coached me well on this and filled in any missing points. He has sat through audits on clients that took both 1244 and 1202 write-offs, utilization, exclusions they're called. So he knows what the IRS asks for, even in an audit. So it's specific to the very law itself. The companies under the definition of qualified small business stock, both 1244 and 1202, which we'll talk about, have to be a C Corp. So your record keeping has to be evidence that they were a C Corp at the time of your investment, their bylaws, if you will. It can be that simple. For 1244 write-off, you have to be part of the first $1 million going in of outside money. So you need a copy of their cap table at the end of the close of the round of which you invested. Just say, hey, how much money did you raise? And let me have a copy of your cap table. You're a shareholder, you should be able to have access to that. Okay, and they have to be in the business of making and selling something. Now, 1244 is kind of interesting because you don't have to hold it for a period of time to get the write-off. If you invest and 6 months later it goes out of business, you got the write-off. So the language of 1244 says they have to intend to build a business where over 51% of the revenue doesn't come from professional services. So 51% or more of the revenue has to come from making and selling something. And yes, SaaS software is you made something and you're selling something. So that's all, and that's intentions. And there's periods of time where you could say, well, gosh, early on it was a service business, but now we've built software around it. We're going to scale with software. So it even doesn't have to be a permanent status, but it has to be based on intent. Now, what Jason said is when he's had audits where they took a 1244 write-off, he's never seen the IRS challenge it. It's a write-off, it's a loss, okay? As long as you have those documents. You were part of the first $1 million and it was a C Corp. And the third qualification is you have to invest it in an equity-like instrument. So again, if you have the term sheet, it'll say it's a preferred stock. It has to be a stock, preferred or common, and nobody invests as an angel investor in common stock. That's just silly. But all these notes that are debt instruments don't qualify.
Even if it's a convertible note or you have to convert it, then you could qualify.
Yeah, but at your original investment, it was a note, so you don't get 1244.
Okay. No, that's great to know. I mean, again, this is complicated, folks. Luckily, Joe's one of the true experts, and Anderson Tax for the ultra wealthy is one of the truly great firms. The CEO is Mark Vorsatz out in the Bay Area, great guy. And
you know Mark?
Hey, of course I do.
Oh, yes. I know him back years ago. Yeah.
Yeah, Mark is very special and really a tremendous talent in the family tax arena. And there's a couple of prominent people, including in my backyard in Greenwich, Ellen, and I'm forgetting her last name. All the big hedge fund managers use her. She's amazing. And Anderson Tax, again, and we've had them on the podcast on different issues in the past. Here's a great question that came in from Chris Ray. And I was going to ask you this one, so Chris beats me to the punch, and you kind of answered it to some degree in your last answer, but I'll ask it again. What qualifies as a small business? Is there a threshold? You mentioned about non-service, about the intent. You mentioned some other things, but are there any other parameters that we need to be aware of?
Yeah, there are a few. The language of 1244 and 1202, again, this definition applies to the 1202 law, which gives you favorable treatment on the gains. Again, we'll get in the weeds on. But it's qualified small business stock is the definition. And then you got two sections of the code that it's relevant to. You have to be a C Corp. You have to be in business of making and selling something, or 51% or more of your revenue comes from the sale of a product. So which means it can't be service business. It specifically excludes rents, meaning real estate. You're not selling something. Royalties, mineral rights. You're not making anything. Those are extractive or intermediaries. What they're literally called rent-seeking intermediaries. Financial services doesn't qualify. So again, if you invest in an accounting firm, doesn't work because they're not selling anything. Okay, this was meant to be specific to entrepreneurial innovative ventures that are creating something new and need that capital to get started, but they're scalable. It also excludes restaurants and the things of retail that are largely lifestyle businesses or, again, are intermediaries.
Let's change our attention a little bit to the QSBS that is probably more broadly a little bit more well-known, and we'll try to take a positive look. Imagine you invest in one of these qualified companies and they don't lose money. They actually make money. God forbid that ever happens. Yeah. So that is known, and you referenced it, that it happened a couple of decades after 1244, and that's 1202. But if you could give us some foundational knowledge about 1202.
Yeah, again, 1202 was passed in 93, right after Clinton got in. As you know, he was close to Silicon Valley in the Bay Area. And it was, again, to stimulate investments in entrepreneurial ventures, but largely by incentivizing with a potential for tax-free profits. And what it says today, I won't go, it's had a bouncing ball where there's been a lot of pushing and shoving, making an AMT preference item, taking it off, and a variety of things. So I won't give you the whole journey. It was passed in 93. It's been updated and it's been a bit of a political football back and forth through the years, but after the 09 crash, they started updating it under Obama, and the law that was signed by Obama in the PATH Act, December of 2015, established the law as it is today. And that is that if you are, a taxable investor investing in a C Corp startup in the business of making and selling something, but you don't have to be part of the first million. You can invest up and until the company has $50 million of net assets on their balance sheet, which would include the proceeds from a funding round. So the cash, basically, plus whatever tangible assets they might have on the balance sheet, which is generally rare. So it could be much later funding round that when you invest, it has to be a C Corp. You have to invest in an equity-like instrument, preferred stock. Still don't want to be in a note. So all that qualifying features are the same, except you can invest much later than that first $1 million. This applies to 1244. And it allows from whenever you invested to the time you have a positive outcome, if it takes 5 years, regardless of which funding round you might have invested in. But from the time you invested to the time you get a successful outcome, if it's 5 years or more, then you can exclude all the gains from capital gains recognition. It's called a 1202 exclusion. You don't even recognize the gain. You make it an exclusion. So you tax-free profits for the first $10 million per shareholder, per deal, and no cap. So if you had 15 deals and they all had huge exit, you'd have $150 million of tax-free profits that year before you'd ever have to recognize capital gains.
Again, must you hold it for 5 or more years?
5-year hold from the time you invest to the time there's an exit has to be 5 years. And once you hit 5 years, then the first $10 million of profits can be excluded from taxes.
Will this also apply to being an LP in a fund?
Of course.
And does the underlying company have to be a C Corp? Could it be a pass-through LLC or something like that?
Nope. Just like 1244, the definition of a QSBS is a C Corp and in the business of making and selling something. It's the same definition.
Now, it's taken a little bit of a step back for a second, but I don't know. I think of most new businesses being formed as LLC. Is that true? Or are there, I mean, I guess there's arbitrage advantages now that may change, but in a C Corp, but how many people starting that kind of company started as a C Corp, or when they start to show some traction, do they convert?
Well, that's a interesting conversation, and there is a lot of advisors out there that sadly advise startups to start as an LLC because the early operating losses you can capture and they pass through and you can capture as the entrepreneur. But the fact is, if you're starting a business and you have NOLs, you probably don't have much of a salary to begin with. You don't need the pass through. And if you're trying to build something that's going to ultimately need outside capital, you'll find most, if not all VCs, very few will ever invest out of their LLC, their partnership, into an LLC startup. They require you to be a C Corp. So it's actually smarter to start as a C Corp because converting, if you start as an LLC and then convert once you start going out to raise money, that conversion process can be bloody expensive and time consuming. So all the pass-through benefits that are offered up and it's cheaper and quicker to start as an LLC, which is true, but that isn't always the best strategy. But those operating losses, while they don't pass through, they do get carried forward inside the C Corp as net operating loss carry forwards. So when the company starts becoming profitable, you're going to shelter some of those early cash flow profits with your net operating, so they don't go to waste. The NOLs are utilized inside the C Corp. So the point being is that startups should start out a C Corp. If you go to Y Combinator, if you go to Wilson Sonsini's library of recommended best practices, they all say the same thing: start as a Delaware C. So the folks that get this and understand startup world will tell you to start as a Delaware C. Now, unfortunately, there's a lot of people giving entrepreneurs bad advice, in Austin here included. Say, I'll be an LLC. It's quicker and easier and cheaper for you. However, oftentimes those people are the same lawyers or attorneys that are going to get paid quite handsomely to do the conversion if that company gets successful to go out and raise money. And that process can be expensive. So I think that at best, there's a lack of knowledge by those attorneys and accountants advising entrepreneurs to be LLCs. There's a lack of knowledge on the QSBS laws. And
for sure. And I could
there's a reverse incentive as well, because they get paid on the back end to do the conversion.
I'm thinking of things that are active among family offices in earlier stage investing. We had a couple of folks on last week that were great, but a lot of it now, especially Silicon Valley, is deep tech, artificial intelligence, quantum computing, blockchain. That's probably not going to quite qualify.
Oh, sure it does. Yeah.
Because it's not a service.
It's not a service.
That's true. Okay. And again, I'm thinking out loud. These
I know, absolutely, but this is the exercise. People wonder, well, SaaS, I'm not actually manufacturing anything like Microsoft used to shrink wrap boxes of software. Well, SaaS is the cloud is just a distribution channel, but you still made something. You made software and you're selling software. It's that simple. If you're making and selling something, what you're selling isn't human capital, time and materials, consulting services. Again, retail is human capital. They didn't make those clothes. They're the intermediary. So there's restaurants, right? They didn't grow the food. So that's how you think in terms of virtually all companies that are entrepreneurial, to bring innovation to whatever industry. It doesn't have to be the deep tech industries. If you're bringing innovation to anything, something new, you're probably going to qualify. If you're a C Corp and you raise money off of a convertible preferred, an old school term sheet, which qualifies.
And how about if you do not hold or don't want to hold that profitable, successful company the full 5 years? I believe there's some alternatives. They may not be quite as attractive, but maybe talk a little bit about 1045 exchanges.
Yeah, and again, if you thought 1202 and 1244, there was little knowledge, there's even less on 1045 exchanges. For those that are familiar with the real estate world and 1031 exchanges, this is in many ways better and easier under one exception. So it's the same thing. In the world of real estate, if you sell a building, you've now got what's called exchange money or 1031 exchange money. You can roll over that investment into another building pre-tax, carry forward your cost basis, carry forward your holding period, all that sort of stuff. That's the same thing in investing in QSBS stocks. So if you invest in a company that's QSBS qualified, it's a 1202 qualified term sheet. It means you invested before the $50 million net assets. And there's an exit, let's say in 3 years, and you put in 100,000 and it's now worth $1 million. You get a 10X and it's 3 years. That's not if you get an exit in that window in time, that's not an unreasonable multiple expectation. You can reinvest some of that $1,900,000 of profits because you got $100,000 cost basis. You can invest some or all of those gains and roll it over by reinvesting in new startups in 1202 qualified term sheets. And you're carrying forward the original holding period, let's say 3 years in our example, and your original cost basis. So now you've got what's effectively $1 million spread out over 10 companies now. You put 100,000 in each of them. And your cost basis in total is still 100,000. But if any of those companies have an exit, you only need 2 years to hold it because you carry forward your cost basis and holding period. So you had 3 years on the first company, you sprinkle it, put 100,000 in 10 new companies, your cost basis in each is 10,000 because it's 1/10 of the original 100,000. And any of those can have an exit 2 years or longer, and you're now at the tax-free window on each one of them. So if all 10 of them have an exit, and let's say they all become $5 million apiece, you've now got $50 million of tax-free profits off a $100,000 investment by rolling it and obviously having that unbelievable batting average of success. So yes, the 1202 says if the company gets sold before the 5-year window, you could take some or all your profits. You can even, unlike the real estate law, you can actually take your cost basis out. Let's say you put 100,000 in, it becomes $1 million. Well, you can take 300,000 out. Book a win. You're done. You don't triple your money in 3 years. That's a great, you're a hero. Now you got 700,000 of house money. You can reinvest that into a bunch of other 1202 deals. And if any of them have an exit, you only need a couple of years holding period, and then all of a sudden you're literally in tax-free profit land. Hold on 1/2 second. So that's the good news. It's easier than 1031 because you don't have to roll over all the proceeds. You can take money off the table, take your cost basis and book a small win and just reinvest house money. Can't do that in real estate. You can also invest it in multiple companies. Real estate, unless you go through what's called a tenants in common and it gets complicated, you've got to put it in all the proceeds in one property. You really have to just rifle shoot. That makes it easier. Now, the one complication that makes it more difficult than a 1031 exchange, in real estate, you've got to believe 180 days to find that new project to roll all the proceeds into. In 1045 land, you've got 60 days to roll it over. So that means you need to be already active and sniffing around and have a pool of companies you're interested in and have done some modicum of due diligence on already. Because you've got, from the time you have your exit proceeds, you've got 60 days to roll it over in a confirmed 1202 term sheet to, again, carry forward your cost basis and the holding period and not have to realize capital gains.
So, I mean, I guess the question I'll have, and you hinted in this direction, many ultra high net worth families are familiar with the tax advantages, which are great, 1031 exchanges in real estate. There's other advantages as well. Many people are familiar with opportunity zones. Yet what you're describing is equally every bit as powerful, again, fitting within certain parameters. Yet somehow, I don't know, maybe their PR teams are not as good as real estate, yet just don't seem to know about it.
Yeah, it's funny. Yeah, Angelo, I've been down this path when the opportunity zones laws hit and there was lots of fanfare and lots of attention. I kept jumping up and down to everybody that was applauding the passing of opportunity zones to mobilize money for more underinvested communities, under startups that struggle to have access to capital, particularly amongst that impact investor world. And they're talking about how opportunity zones are going to be the savior. And if the legislation is largely a giveaway to real estate investors that already have a profit locked in, they want to roll over their profit tax-free. And I was just jumping up and down to that audience saying, look, there's these QSBS laws that are also specific to incentivizing investment just in startups. You don't have to worry about the real estate complications. They're just for startup investing. None of them would listen. None of them would listen. They were so locked in on opportunity zones and whatever their business model was to launch an opportunity zone fund or promote the opportunity zone incentives or whatever, however they had attached themselves to the opportunity zones. They didn't even think about or talk about the QSBS laws, largely because they're unfamiliar with them. And they didn't want to look stupid.
Now, since we're October of 2020, the elections are what? 2 weeks away, actually, yeah. Literally on the button. And not to make it a political discussion, but in theory, if the Democrats sweep, they already made some level of likely what they're going to do from a tax perspective. And it basically is our taxes going up. I don't remember seeing anything in there about this. And again, the tax code is, thousands and thousands of pages. This is probably barely being used to begin with. I am assuming it's not really on the radar, but the more popular it becomes, the more people use it. And maybe it takes 5 to 10 years to catch up. I don't know. Again, anytime you have a tax discussion on something that's being recorded that people could listen to a year, 10 or 20 years from now, none of us know. Joe, not I. Tax laws may change in 2 or 3 months. It's not impossible. It's possible. Who knows? So that being said, are you hearing any rumblings that it's in the crosshairs of anyone? I wouldn't think so. It's just not utilized enough.
Well, it's not. And again, I've been jumping up and down about getting specifically 1244 indexed to inflation again, because it was indexed in 1978 under Jimmy Carter's administration in the Revenue Act of 1978. So from a political standpoint, there's nobody on either side of the aisle that would be against indexing this again, principally as a way to stimulate investment in innovation. Unlike opportunity zones, the tax benefit goes to investors that invested their money that had already been taxed once. Remember, they invested in a startup and that money had already been taxed. It's not like it doesn't fall to the benefit of your IRA account or your 401k. So this is money that's already been taxed. You took that, put it in a startup, and if it fails, you then simply get to lower your taxable income in that reported year from that loss on money that you invested that had already been taxed. So again, politically, there's no reason for this to not get embraced. Now, again, I have been I'll call it a one-man lobbying effort because I brought it to the attention of my local senators, congressmen, the Small Business and Entrepreneurship Council, Karen Kerrigan, who runs that for 25 years. I got her attention enough that she included the need to index 1244 to inflation in her testimony in front of the House Financial Services Committee. It was both part of her spoken testimony and a written testimony. So part of the congressional record, technically. So that's the closest we got to bring it to anybody's attention. But as I've learned, if you want anybody's attention in Washington, you have to pay for it. You have to pay a lobbyist. I've been back to DC on a couple of occasions speaking to a room full of staffers on this tax law. But getting follow through, to get somebody to care enough about it, to push it through, to make it a priority, that's a formal lobbying effort that takes money. Even though these congressmen or organizations claim they care about startups and small business and helping mobilize capital for them, the reality is to keep their attention, to make them care enough to push something like this through, takes money. And I haven't spent the money on a lobbyist.
Makes sense. And again, the more attention it gets, ironically, the more it may get in the crosshairs. So it's a strange balance.
I've got a guy, Dan Carroll, who I got to know recently. He is the head of capital markets and policy for the Milken Institute. And Dan's a longtime policy guy, basically a guy that's navigated Washington for a long time. And he's got a brilliant resume. You can look him up under LinkedIn, but he didn't know about these laws. And he went, holy cow. Well, he says, I'll be your Sherpa through Washington, through the hellhole of Washington. And he literally had an exchange with him earlier today. And he said, Joe, because Milken's got a big conference going on right now. It's a 10-day conference going on. There's several people talking about at that breakout, at that conference, about the need for this exact, what 1244 would satisfy. These tax laws would mobilize more. There needs to be more money flowing to more regions in a broader definition of what's fundable. Because innovation comes in all walks and sizes and shapes and forms, and they're viable businesses. They might be unicorns, but that's nonsense. So few are anyway. There's a lot of good businesses out there that would benefit from a more efficient flow of capital that could make money for their shareholders on an absolute risk-adjusted basis, that's not swinging for the fence, but getting an audience with money, whether you're in Silicon Valley or God forbid anywhere else around the country, it's really difficult. And these tax laws would provide the incentives to stimulate more investments into a broader audience, take the sting out of the losses, and also reward the gains as they were originally intended. This happened once before when the ERISA laws changed in '79. We saw an explosion of new money coming into venture funds, and new funds were formed. And then you had a lot of innovation that sprung out of the '80s because it got funded by these new venture funds that captured all this new money coming from the pension plans after the ERISA laws changed. I think the same thing could happen with the broader audience of innovation if these QSBS laws mobilize particularly that impact money. Those family offices that really do want a good return, but they also care about how they make that money. That's just classic impact. Whatever the families define as impact, whether it's the environment or gender diversity or ethnic diversity or just their community. That's called place-based impact investing. They just want to see the vibrancy of their home community, stop the brain drain, give the young people an exciting future, have that vibrancy of a downtown, all those sorts of things that are you'd almost put under the economic development category, has been properly labeled place-based impact investing, where geographic location is simply the impact criteria.
Absolutely. I mean, like you said, when you mentioned with Jimmy Carter and the Democrats, this is something, especially during COVID, especially we want to spur investments into people that have the guts and grits to want to create and start something and potentially be incentivized to do so. This should be, whatever, bipartisan. It's not, it could be impact investing centric, which is a little bit more to one camp than the other. But yet somehow when it comes, like you said, to politics, to taxes, to lobbyists, it just gets complicated, doesn't it?
Well, and I've actually written a white paper on why shouldn't we have QSBS funds like we have opportunity zone funds. They would be a no-brainer, where you could optimize on both 1244 write-offs for the companies that made their way in but failed, but also manage to assure you're going to get the 1202 tax-free profits.
By investing in a fund.
Yeah. It's a real fund.
Yeah.
But you benefit from diversification. Instead of trying to do this transactionally, why not have a diversified portfolio? So you're actually managing portfolio risk and optimizing on the taxes, both on the downside and on the upside. You can do that. And within a fund structure, you can optimize on 1045 exchanges as well, because you could reinvest on one of your portfolio companies that had an exit in 5 years. You could reinvest in one of the other portfolio companies that had an open term sheet.
And Joe, for those, before we get to that, we have a couple of minutes left. Maybe tell us a little bit about your company, AngelSpan.
Well, now is when you ask, but we literally built the tools and platform to optimize on some of the very things we've discussed. I was an active angel investor, ran a multifamily office, was early in we now label impact investing back in the mid to late 90s with some of my old money clients wanting to piggyback some of my angel activity. But there wasn't a way to invest well, meaning just manage risk properly. Get off this sort of pitch fest, angel pitch, transactional approach and manage a portfolio of this, whatever you want to do. That's how you manage serious money in the public markets, diversification, dollar cost averaging, some of the basic risk management tactics done in the public markets. There just hasn't been the tools to follow and pursue those same risk management and portfolio management disciplines in the private asset class. And so what AngelSpan is a platform, and one you could broadly define it as a solution, because there is a human component. Although we do qualify for QSBS ourselves, there is a human service component to what we do. It's just not over 50%. That creates proper reporting, transparency, and analytics at the individual company level. So think investor relations meets Wall Street research, company-specific research. Because again, you need to be able to get good information and good analytics to utilize 1045 exchanges. You have to have information at a time.
You have to move pretty fast. Yeah.
That means good information at individual startup level, which is what AngelSpan's core service provides. Sort of like public market investor relations and Wall Street type analysis at the company level. We take the analytics and we've availed it to investors through a second division we've called the legacy funds. And that is where we're trying to help mobilize what we call legacy capital or legacy funds, impact money, if you will, purpose-driven money, well-intended money, into this asset class better, i.e., better returns, risk-adjusted returns, and better utilization of the very QSBS laws we're talking about. So our legacy funds platform literally optimizes on managing non-systematic risk through proper diversification, systematic risk through dollar cost averaging, proper capital deployment strategies, a decision process risk by having quality data define what you're doing, and to optimize on the QSBS tax laws. That's all in our legacy funds division. So we license that platform actually for free to anybody that wants to actually manage money with those criteria in mind. They want to get off the transactional approach and really deploy capital with both meaning and effectiveness and utilize these tax laws. So that's what AngelSpan does in our legacy funds division.
And Joe, for those that would like to learn more about what you spoke about in our discussion, as well as AngelSpan, how could they learn more about you and how could they contact you?
Well, it's easy. Joe at angelspan.com. Angelspan.com obviously is our website. It's simple as Joe at angelspan.com.
Great. And everyone, Joe's last name, Milam, is spelled Milam, as in Mary. Joe Milam, founder and CEO
Angelo,
of AngelSpan.
I normally wouldn't care to correct you, but I have to correct you. It's actually pronounced Milam.
Milam, okay.
Milam.
As long as I spelled it correctly.
You spelled it perfectly. And the reason I care is that in Texas, one of my ancestors is considered the first hero and the first martyr of the Texas Revolution, named Ben Milam.
Wow. Yes, it needs to be pronounced correctly then.
That's why. So.
And I'm going to give a little bit of a close now. I really, really enjoyed this discussion. I'm a huge fan of people that are entrepreneurs, very intrigued by startup and VC investing. Hell, one of the things I talk about are for some family offices to effectively internally create their own VC. And these opportunities that were spoken about today from a tax perspective are just tremendous. Now, I will note, as I've said throughout, these are very complex. You need to consult and do your own research, consult with your tax advisor, get an opinion, a second opinion, whatever you call it. And we're doing this October of 2020. I don't know. You could be listening to this April of 2021 and some laws changed, or 5 or 10 years from now. Maybe they're better. I just don't know. So again, this is meant to be educational at this point in time. And even then, at this point in time, you need to effectively do your own research and your own diligence. But hopefully you found it to be an engaging and entertaining discussion. Joe was a great guest and look forward to him coming back and discussing angel investing and much more many, many times. Everyone, I am Angelo Robles, the host of the Angelo Robles Podcast, founder and CEO at Family Office Association, a global membership organization dedicated to families of wealth and their family offices. We provide a significant amount of original proprietary content. Some of it you heard today in a recorded format, mainly for the value of our members. And one of my members put it best, you kind of went from doing 10 events a year to doing 200, because practically every day, at least Monday through Thursday, I host a daily member Zoom. And sometimes we make it more public via YouTube, and even rarer still on my podcasting platforms. But our members get real-time invite. They could interact. They get all of them. They get a weekly recap. They get access to our past Rolodex or library, I guess you could say, of content and videos, et cetera. And our master classes that we host, some of them live, some of them multi-hour, 6 to 7 hours pre-recorded, on everything related to creating or reinventing the family office. So have a chance to learn a little bit more about us. I'm very active on social media, on YouTube, or simply Family Office, very active on LinkedIn, Instagram, and the other platforms. And our website, which was completely revamped and updated about 5 or 6 weeks ago. And simply like Joe's company, our company name, FamilyOfficeAssociation.com. And my email is angelo@FamilyOfficeAssociation.com. Thank you so much, Joe. It was great. Look forward to the next time. Thank you, everyone. Have a great day. Thank you.